So 11-24 is asking us to look at two other ways of analyzing the profitability of a company. So the first requirement here is calculate that each division's RI. So RI stands for residual income. So residual income is the amount of income, your operating income, less your minimum expected acceptable income. And minimum acceptable income is your rate of return times your total assets. That's what's been defined for this company. So how much residual income is left over after you've earned what the targeted earnings are that have been identified by the company. So your residual income, so it's your operating income for residential, the 63.5. The return on assets, so the assets are $205,000. They've identified in the problem, and this is a given. You're given this in the problem, the 25. They want a 25% return on their investments, on their assets. So you subtract the two, the actual operating income less the return they require, and you can see here that you have residual income or additional income over and above what they require of $12,250. You do the same calculation for a professional division for residual income, and you can see that they have $71,250, quite substantial amount of money over and above what is required for that company. So the next one we're going to look at, requirement 2, is to calculate the EVA, so your economic value added. EVA is economic value added. So this is another way to evaluate the performance of a company and of the divisions within a company. So here you are going to have to memorize this formula. There's no way around that. So you're looking at EVA. It's your after-tax operating income less total assets minus current liabilities, and you're going to multiply that by your weighted average cost of capital. And the weighted average cost of capital is given to you in the problem, and so that is given to you as 15%. So the economic value added for the residential division, you're going to take your after-tax operating income. So you're told that the tax rate, your tax rate is 30%. So therefore, what you're going to do is say your after-tax operating income is the difference. So it's the 100 minus your 30, and that's where the 70 is coming from. So 70% of your income is now available because you had to pay taxes equal to 30%, and then the assets minus current liabilities times your weighted average cost of capital of 15%. And that works out to be economic value added of $24,200. Do the same calculation for professional, and you'll see that works out to be $81,750. So both have a positive economic value added, so they're both adding and creating value for their shareholders and creditors that exceeds the rates that are required. So as long as it's positive, as long as economic value added is positive, then you're exceeding expectations. And I will leave you with part 3 or requirement 3 to read on your own. So that concludes 11-24.